The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining today's webinar. Following on from APRA's discussion paper released earlier this week with regards to Australian bank hybrids, we want to provide an update to our investors and provide a summary of the paper, as well as our opinions on the market impacts, with particular reference to our relevant ETFs being HBRD, BHYBE, and BSUB. Today's discussion will be between Chamath De Silva, the head of fixed income here at Betashares, and Christopher Joye, the CIO and founder of Coolabah Capital. Both are very experienced members or participants in the Australian fixed income markets, and between them, their teams manage around $18 billion of investors' money, including across the entire bank capital stack. So both are very well placed to comment and share their opinions on APRA's paper. In saying that, today's webinar, the information will be general only. It does not take into account any individual circumstances. Finally, today's webinar will be recorded. We'll send a recording to you following the event. Please feel free to ask questions throughout using the chat function. We'll endeavour to get to a few of these questions at the end of the event. Anything we don't respond to will come back to you directly via email. With that, Charm, I'll hand to you to lead today's discussion with Chris.
Great, thanks, Tom. Chris, it's always great to chat, but let's dive right into it. So what exactly did APRA announce this week? Was anyone expecting it?
Yeah, it's fair to say, Chum, firstly, thank you for inviting me to this webinar, and thank you to everybody who's dialed in. We realise you're very busy. Secondly, nobody was expecting what APRA proposed, which is the elimination of the bank hybrid market, but not the insurance market, which is one curiosity in and of itself. APRA never canvassed this possibility when they published an initial discussion paper in late 2023. What they have released is a new discussion paper with a proposal to eliminate bank hybrids, and that will be in consultation until mid-2025. So there's a fairly long timetable, but APRA does look like it's zeroing in on a solution. What is that solution precisely? Many years ago, I had actually said to APRA, it would be better to get rid of hybrids and just have equity and debt across a bank's capital structure. People don't think about bank capital structures this way because we look at the shares on the ASX and we see, CBA, hundreds of billions of dollars of equity trading on the ASX. But CBA's equity, in very simple, generalized terms, and these numbers are not exactly right, think of that as a very small slither of the capital structure, depending on how you measure it, between circa 6% and 12% of CBA's funding. And the rest comes from hybrids, subordinated bonds, senior bonds, secured senior bonds, and deposits. And APRA has proposed, in the ashes of what happened with Credit Suisse, where ironically the hybrids did exactly what was intended, to get rid of bank hybrids starting in 2027. So the phase-out period would begin in 2027 and end in 2032, and replace them with mainly subordinated bonds. So hybrids count as equity on a bank's capital structure. There are two types of equity, normal or ordinary equity, which is known as common equity tier 1 capital, or CET1. And then there's additional tier 1 capital, which are hybrids. So tier 1 capital is equity, and APRA is proposing to remove the equity banks hold on their balance sheet, the hybrids that banks hold on their balance sheet. Across the four majors, that is currently worth 2.15% of their assets, or about $38 billion. And it's going to replace the 2.15% of hybrid equity with a combination of tier 2 bonds, which will be an extra 1.25% of tier 2, and then a tiny bit of extra equity, true equity, which will be 0.25%. You add those two things together, you get 1.5% of replacement Tier 2 and equity capital, replacing the 2.15% of hybrids. And the way APRA is proposing it could work is this starts in 2027, and as hybrids mature, they'll be replaced by Tier 2 bonds. But they've got many more hybrids than Tier 2 they need. They've got 2.15% of hybrids, and they only need 1.25% of Tier 2. The extra equity they have to raise, the 0.25%, needs to start, or it needs to be there in 2027. And then a few other wrinkles. Nothing will happen to insurers. So insurers will keep on issuing hybrids. So we'll still see insurance hybrids from Challenger and IAG and possibly the likes of Suncorp and QBE on the ASX. And the other interesting thing is that with the non-major banks and Macquarie, that those 5 institutions are one bucket, basically all other banks, their hybrids will go, but they'll only be replaced by Tier 2 bonds, not by that extra little slither of equity.
It's quite a big change, Chris, but what do you think motivated APRA's decision? So remembering they had a discussion paper out last year in September, and there were talks about maybe overhauling the AT1 or hybrid market. There was some talk about maybe introducing a new flavor of hybrids with a 7% capital trigger, but there was no suggestions of phasing out the market altogether. Just keen to get your take on why APRA might have made this decision.
Yeah, and also for everyone listening, from my perspective, I don't mind whether we have hybrids or don't have hybrids. If they want to get rid of hybrids, I'd rather they replaced it with equity, which would be the smart thing to do. If you're removing equity, you need to replace it with equity. APRA's done a very, very bizarre thing, which is they're saying, let's get rid of hybrids and replace it with debt. We'll talk about this later, but they're actually going to increase bank leverage and increase bank risk. And they have not highlighted this in this new paper they've released, which is also very odd. But why do they want to do this? It's not going to make a lot of sense, but when I explain it to you, but ostensibly they said, oh, well, Credit Suisse collapsed, and we therefore need to review the hybrid market, because they argued that when Credit Suisse collapsed, the hybrids did not work as intended, and the hybrid market became illiquid, and banks couldn't issue hybrids. All those statements, if you ask any bank on the planet, they would say they are incorrect in the context of the Australian hybrid market. In the month that Credit Suisse collapsed, about $1 billion of hybrids turned over on the ASX. So ASX hybrids were super liquid. ASX hybrid prices didn't fall materially. Spreads only moved a very modest margin. So the integrity of the ASX hybrid market was super strong in March 2023 and in April and in May. Within a month or two, CBA had issued a new $1.55 billion hybrid. So not only was secondary trading on the ASX in the hybrid market in the month that Credit Suisse collapsed super liquid, but the new issue market was super functional because CBA was able to issue a massive $1.55 billion hybrid within a couple of months. What about the argument that that Credit Suisse's hybrids didn't work as intended? That's just totally wrong. I was speaking to a major bank treasurer about this last night. Credit Suisse's hybrids were write-off hybrids, very different to Aussie hybrids. What that means is they don't convert into equity. So a CBA hybrid converts into equity, it doesn't get written off. And it converts into equity if CBA's equity ratio falls from 12 to 13% currently down to just above 5%. And there's no discretion, it just happens. In the case of the Credit Suisse hybrids, they just go straight to write-off. And that's what happened. Over the weekend that Credit Suisse collapsed, their hybrids were completely written off, and they actually recapitalized Credit Suisse and provided Credit Suisse its acquirer, UBS, with more than 10 billion of equity through the write-off of the hybrids, eliminating a liability. And so everyone in the world was amazed at how quickly they were written off and how seamlessly that process worked. What didn't work was the equity should have also been written off, and the Swiss regulators didn't fully write off the equity. But that has nothing to do with the hybrids. That was the Swiss regulators' choice about bailing in the hybrids and not bailing in the equity. And at the time, I criticized that, and I had predicted years ago that this would happen if you have a hybrid that goes straight to write-off and that doesn't convert into equity. When you have a hybrid that converts into equity, you dilute shareholders down, so they suffer first, then the hybrids suffer. In the case of the Credit Suisse hybrids, they went straight to write-off. So APRA was, I think, on a mission to review the hybrid market, and it used Credit Suisse as an excuse. And I've spent hours with APRA and explained that the Aussie hybrid market was super liquid in the secondary market. The primary market was super functional. Aussie hybrids have always worked as intended. It's a $40 billion market that's actually been immensely successful. And there's no lessons from Credit Suisse really at all for any Aussie hybrids. APRA's mission, when it launched that paper, that consultation paper in late 23, Chum, was a fewfold. They wanted to basically increase the level at which hybrids convert into equity. Currently, as I mentioned, they convert into equity at an equity ratio slightly above 5%. They wanted to increase that to 7 to 8%. APRA also had a bee in its bonnet, and this is the real driver, about retail investors holding hybrids. And APRA was nervous that if hybrids converted into equity in a crisis, that APRA would be blamed by retail investors for any losses that they suffered. And so APRA had two key ideas that it canvassed in the report. One was, let's increase the level or the trigger at which hybrids convert into equity from sort of just above 5% to say 7 to 8%. A second idea was, how can we stop retail investors holding hybrids and shift them only into fund managers' hands? And they had this idea of shifting hybrid issuance into the unlisted market and off the exchange, or maybe increasing the minimum denomination of a hybrid holding from, say, $100 to $100,000. And then the only other option they canvassed was reducing the amount of hybrid capital that banks issue. So they talked about reducing the reliance on the hybrid market and reducing the level of hybrid capital in the capital structure. At no point did they ever talk about eliminating the hybrid market. Again, personally, I don't mind if they do, but I'm just giving you the facts. They never talked about eliminating the hybrid market, and no one I know ever spoke to them about that. And what seems to have happened, Chum, is they've discovered that it's not super straightforward to increase that threshold at which hybrids convert into equity, is what I've heard from the banks. And they also discovered it's very hard to kind of ban retail ownership of hybrids. And so they've thrown their hands up in the air and they've just said, you know what, let's get rid of hybrids. Now, here's a few points. No one has ever done this. There's no banking system in the world that does this. It's completely unprecedented. You basically torch a $40 billion market. Again, personally, I don't mind, but the brokers and the retirees and the SMSFs who love hybrids will mind. You're reducing a key funding market for banks that is proven. You know, Macquarie issued hybrids in 2008. Macquarie issued hybrids in 2020. CBA issued a hybrid just after Credit Suisse. This is a very flexible market that banks have repeatedly tapped during crises. And you're also, as a result of this change, it will mean that all normal banks in Australia will no longer comply with the Basel III banking rules. The four major banks in Macquarie will continue to comply with the Basel III global banking rules. But because the regional banks and other smaller banks will lose their hybrid capital, the hybrid capital will disappear, their equity ratios will fall, and they will fall below the Basel III minimums. And so currently they're all compliant. Now all the normal banks in Australia will no longer be compliant. So it's really quite odd and interesting.
Chris, just based on that, does that make these proposed changes? Do they make banks, Australian banks, more risky as a result?
Again, for those who have currently joined, APRA is basically saying we're going to get rid of the 2% hybrid sleeve. Now, technically, the hybrid sleeve within a bank's funding stack is a minimum of 1.5%, but the four majors in Macquarie hold about 2.2% of hybrid capital. Across the four majors, 38 billion. If you take that equity out of the capital structure and replace it with debt, subordinated bonds, what happens? It's like you buying a home and using a 12% deposit and borrowing 88% from the bank. And then you go to the bank and saying, actually, I don't want to put a 12% deposit down. I only want to put a 10% deposit down. And I need to now borrow 90% from the bank. So mechanically, you're reducing equity, increasing debt. And so, yeah, the bank's leverage increases, and it actually increases significantly. You're talking about a 17% reduction in the bank's equity capital. Now, why this is really bizarre is that since 2014, APRA, frankly, on partly our guidance, like I wrote the terms of reference for the 2014 financial system inquiry for Joe Hockey with the former CEO of CBA, David Murray. But we forced the banks to raise $150 billion of equity and their equity ratios increased. In 2007, CBA's equity ratio was 4.9%, and it was basically more than 20 times levered. Today, its equity ratio is 12 to 13%. So the banks have increased equity, reduced leverage, reduced risk, and this does the exact opposite. Just because APRA doesn't want to bail retail investors into bank equity at a time when that equity is probably going to be very cheap in a crisis, when a bank's failing, APRA doesn't want to deal with the repercussions. So yes, the bottom line is banks get riskier. Bank bonds at the margin get slightly riskier because there's slightly less equity protecting them. And it doesn't matter how you cut the numbers, bank leverage increases, and the credit ratings on bank bonds are probably not going to change. So the tier 2 ratings and the senior ratings probably won't change. But the strength of those ratings unambiguously declines a little bit, right? And we've seen that in the price action, the market reaction. So why would APRA want to increase the risk of the banking system and destroy a $40 billion super functional, super successful market that has proven to be resilient in March 2020, in the Credit Suisse crisis, in the GFC? Hybrids traded in the GFC. I mean, yeah, their spreads blew out, but they traded every day. And it's apparently just one guy at APRA that's driving all this. I won't name who he is. Again, personally, commercially, we don't really mind either way. Whether we have hybrids, don't have hybrids, doesn't really change the price of tea in China for us. But it's kind of a weird policy conclusion, and no one expected it. It was never canvassed as an option in their consultation paper, and that's why they're now having to consult again. They've been consulting for 12 months, Chum. They're now proposing to consult all the way through to mid-2025 because they consulted for 12 months. They didn't talk to anyone about this idea. They've come up with this idea, and so they've got to start again.
Yeah, and that's a good point you make about the consultation period, because there will be a lengthy consultation period by the sounds of it, in addition to a fairly lengthy transition period to this new frameworks, starting in 27, but fully taking effect in 2032 when the final first call date for the existing hybrids outstanding happens. Chris, maybe let's change track to maybe the market's reaction. So for the last 2 days, we've actually seen listed bank hybrids rally. Tier 2 spreads haven't really done a whole lot. Is the market right? And what's your view regarding the supply and demand picture for both AT1 and Tier 2 going forward?
Cool. I mean, that's a great question, Chum. And I'm going to hit you guys with a few numbers. I don't mean to bamboozle anyone, but I'm going to give you a bit of data to cogitate on. So really, in short, as you described, hybrid prices have jumped, hybrid spreads have compressed. Now, hybrid spreads were already super tight. The extra, I was about to say interest margin, but technically hybrids don't pay interest. They pay what is called a distribution margin. But the extra return you earn above the RBA cash rate on a hybrid, that extra return was the tightest or lowest it has been ever since the GFC before this announcement. And it's become even tighter again. And the rule of thumb or heuristic investors are using is the following in light of what APRA has said. APRA has said we now expect all bank hybrids to be repaid. And so the repayment risk on hybrids has superficially disappeared, assuming this comes to pass. And so then investors have said, well, hybrids now kind of look like Tier 2 bonds, which are subordinated bonds that sit between hybrids and senior bonds in the capital stack. And therefore, the extra return we need from hybrids should be close to Tier 2. And that, there's some merit in that argument. The challenge is that hybrid spreads were already at their tightest levels relative to Tier 2 bonds since the GFC. In fact, they're actually at their tightest levels ever. So the extra spread you get on a hybrid above a Tier 2 bond, on a 5-year hybrid issued by one of the 4 major banks above a Tier 2 bond right now is about 20 basis points, or you only earn 0.2% per annum in extra return allocating to a 5-year CBA hybrid over a 5-year CBA Tier 2 bond. We've really never seen that differential before. Even in 2007, I can tell you off the top of my head, it was about 100 basis points of extra margin from hybrids. Now, the thing is, hybrids still have all their risks. They can still have their distribution stopped. Once a bank's, this is not well known, I doubt anyone on the call knows this fact, but once a bank's equity ratio, they're currently sitting around 12%, falls to 10.25%. Below 10.25%, APRA can stop banks paying hybrid distributions. And then if it gets all the way down to below 6%, distributions disappear. And if it goes down to 5%, the equity ratio, hybrids get switched into ordinary shares. May not be a bad time because you could pick up those shares cheap. All those risks stay until 2032. Tier 2 doesn't have any of those risks. Tier 2 are subordinated bonds. It doesn't have any of those risks. It pays interest. The interest can't be stopped. And it doesn't automatically convert into equity. So the other point is that hybrids are less liquid than Tier 2, ostensibly. There have been periods where hybrids, I would say, are just as liquid as Tier 2. So, it's splitting hairs on the liquidity point. But you should always command an extra return from hybrids than you would from Tier 2. So we wouldn't want to see those hybrid spreads trading inside Tier 2 spreads. And they're almost there. So 5-year Tier 2 is paying about 170 over, and 5-year hybrids are paying roughly 190 over. So you're not getting much extra return. Could we see hybrid spreads rally down to the Tier 2 curve? Possibly. So there may be some extra juice there, but I'm not super keen to buy hybrids here, put it that way. What will hybrids do in the meantime? I think a lot of investors will continue to hold them. They know they're going to get repaid at their call date or their expected maturity date. The market reaction in Tier 2, as you mentioned, was very anodyne. Spreads have hardly moved. Spreads in Australia went just 1 basis point wider, 0.0% increase in spreads. Sorry, 0.01% increase in the spread. And in the US and Europe, it was a little bit more. Like in the US, about 2 basis points we measured. Yesterday, hybrid spreads were tight, Tier 2 spreads were tighter, even though we had a subordinated note issue from ANZ that was very successful. There was over 3 billion in demand for the ANZ subordinated note. Slightly different, it was an ANZ New Zealand issue in Aussie dollars. So the Tier 2 or subordinated bond market hasn't done much. Hybrid spreads have compressed, hybrid prices are higher. In the products we run, performance has been strong. HBRD's done well, BHYB's done well. The thing about the Tier 2 market now, the nuance is this. There are 38 billion of hybrids outstanding from the 4 majors alone, about 41 billion of total hybrids on the ASX. If APRA's proposal is implemented, and may not, but if it was implemented, the 38 billion of hybrids disappear, basically. And on APRA's proposal, you don't need to replace it with 38 billion of Tier 2. You only replace it with 22 billion of Tier 2. So what that means is hybrid investors who own 38 billion of hybrids, APRA has said that they expect some of those investors to switch into Tier 2, and the 38 billion number is obviously much bigger than the 22 billion number. And so therefore we have negative supply, or what we call negative net supply. The demand is much bigger than the new issuance of Tier 2. So I actually think, and this has been the reaction we've seen from global investors offshore, it's probably net positive for Tier 2 because you're going to have more buyers than issuance. The negative for Tier 2 is that there is less of a buffer protecting Tier 2. That 2% sleeve disappears. But that's also true of senior bonds and deposits. Everyone has less buffer. The Aussie banks are the best equity capitalised banks. Most people would say, or amongst the best capitalised banks on the planet. Their equity ratios are meant to be unquestionably strong. It wouldn't surprise me if this proposal gets tweaked and APRA swings around to the view that actually maybe it doesn't make sense to get rid of all that hybrid equity and replace it with Tier 2 debt. Maybe we actually ask the banks to raise a bit more equity and issue less Tier 2. I would be pretty surprised if we didn't see it tweaked in that direction, because what they're currently proposing doesn't seem to make a lot of sense. Lever up the banks, reduce equity, increase risks to bank depositors, all in the name of protecting APRA's reputational risk around hybrid equity conversion, noting that no regulator in the world has ever done this. This is totally unprecedented. And also noting that aside from the 4 major banks and Macquarie Bank, every bank in Australia, as a result of this policy proposal, will breach the Basel III banking rules because their minimum equity capital will now be below the recommended Basel minimum. Doesn't make sense.
Chris, just on Tier 2 issuance. Now, the Australian banks get their Tier 2 funding from a combination of, the domestic market as well as offshore. Are you able to maybe, briefly explain, how this offshore Tier 2 market for our bank credit works, and how do you view it from an investment perspective? And maybe that can lead us to, I guess, HBRD and its fairly broad universe of eligible instruments.
Yeah, I mean, on HBRD, we designed that. Betashares and ourselves sat down and said, we don't want this to be a hybrid ETF. So HBRD, in its first PDS, and has always been sold as what we call a full capital structure ETF. And HBRD has always held cash, it's held senior bonds, it's held tier 2 bonds and hybrids. But crucially, when we designed HBRD, we said we just don't want to be limited to the listed market. We want to be able to trade unlisted bonds, which we've done a lot in HBRD. And we also want to trade Aussie bank bonds in foreign currencies. And we've always been able to do that in HBRD. And historically, the banks have issued, rough numbers, the 4 major banks have issued about half their bonds in US dollars and euros and other currencies and half in Aussie dollars. So they issue about 150 billion a year. And roughly half of that goes in overseas currencies and half in local currencies. And what we find, Chum, consistently, you know this, given your tremendous expertise also in the global fixed income markets, sometimes the CBA bonds in US dollars are much cheaper than the Aussie CBA bonds. Sometimes they're more expensive. Like literally in the last year, we've seen periods where CBA senior and tier 2 bonds have been cheaper or more expensive than their equivalents in Aussie dollars. So we are buying and selling at Coolabah $500 million to $1 billion of bonds a day. For HBRD, we have 50 staff, 11 traders, 15 analysts, and we're trading global bonds and hybrids for HBRD. And that opportunity set is massive. It's $28 trillion. If the hybrid market were to disappear, HBRD would just do what it's always done, which will be a roaming full capital structure bank and insurer ETF. The insurance hybrids that still list on the ASX will continue to trade. If we see insurance hybrids in the OTC market, we'll trade those. We'll trade subordinated bonds. We'll trade senior bonds. In HBRD right now, about 30% is in hybrids, about 50% is in tier 2 subordinated bonds, and about 20% is in senior bonds. So we've been full capital structure of late, and frankly, if it wasn't for this proposal, we would be sort of inclined to continue to reduce our weight to hybrids, because hybrid spreads are paying the lowest extra return above subordinated bonds and senior bonds that we've ever seen. And as I mentioned, how much more runway is in the hybrid market is fairly limited, given you're only earning 0.2% above sub debt right now, like for like, CBA, 5-year, all like for like. So I'm really excited about the opportunity set. We definitely get better margins and better interest rates at various times in US dollars and euros and sterling on Aussie bonds than we do in the Aussie dollar market. I would say, Chum, that we'll probably see issuance of, if we assume that everything APRA has proposed comes to pass, what will probably happen is you'll see listed tier 2 bonds and unlisted tier 2 bonds, but you also see a lot of global issuance of tier 2. So you'll see, as we do, the majors issue about 18 billion a year of tier 2. They've only got 8 to 9 billion of maturities next year. Next year, there are only 4.9 billion of hybrid maturities. So the total issuance of tier 2 is actually likely to step down. And because the banks are actually carrying 2.2% of hybrids, and they only have to replace it with 1.25% tier 2, they don't have to start till 2027. We're not likely to see a massive amount of issuance over the next couple of years. So nothing's going to change really for the next couple of years. And frankly, nothing's going to change, period. Hybrid issuance, if it came to pass, would stop. The hybrids would all mature. They'd be slowly replaced over time with tier 2. But issuance is likely to be pretty modest. But I think if you're interested in holding Aussie senior bonds via coupon or Aussie subordinated bonds via B-sub, or a combination of both via HBRD, HBRD has the flexibility of moving up and down the capital stack depending on the relative interest rates we can access. But HBRD crucially and quite uniquely has the flexibility to buy global bonds. But also, and this is important, we're able to buy fixed rate bonds and hedge them to floating, not just buy floating rate notes. And the banks issue overseas more fixed rate than floating, and domestically they do a lot of fixed as well as floating.
Yeah, it's something that we've noticed. There's been a lot more fixed rate bond issuance from the banks in recent years. Chris, probably an important point, given that there are hybrid holders. Now, you've been, I guess, pretty constructive on tier 2 and senior, in recent times. just on relative pricing. That being said, for existing holders of hybrids, I guess if they're happy to hold it right now, this APRA proposal, in your view, doesn't really give a reason to sell. I assume it's not a negative development for hybrids. In fact, possibly
it's unambiguously positive for hybrids. Insofar as you just had the call risk or the repayment risk removed, so you're getting guaranteed repayment of hybrids. You still have all the other hybrid risks, the equity conversion, the distribution, escrow risks. But there's no negative from this. And I think we'll see hybrids become more hold to maturity. A lot of people will just bottom draw them. We've seen very good turnover in the hybrid market since the announcement. So a lot of really good liquidity. The only rider I would add is on a relative value basis. It feels like it's all already in the price. This proposal, hybrids were really expensive, arguably, before the proposal. They just got a lot more expensive. And you're only getting 20 basis points a year in extra margin over a tier 2 bond. So, some people might say, okay, I'm going to roll the dice and hope my hybrid spreads converge such that they equal tier 2 spreads, in which case there's more upside. It's even possible, I don't know why they would, but they could trade inside tier 2, even though they're much riskier than tier 2. But it's all kind of more or less in the price. I do think if you think it's in the price, there is an opportunity to get better relative value up the capital stack through HBRD, through B-sub, through coupon, and through, I think, the very smart design of coupon, B-sub, and HBRD. Particularly, I think, obviously I'm biased because, we run HBRD, but we can go global and we can do fixed and floating.
That's great, Chris. And again, it's probably worth just emphasising that this is going to be a fairly lengthy process, both starting with the consultation process and the implementation process. While it's likely that new issuance of hybrids will stop, the existing hybrids still have a fair amount of runway left, given the maturity profile or the first call profile. But with that, I might invite Tom back to go over some listener questions.
Yeah, thanks, Chamath. Thanks, Chris. A very insightful discussion. Look, cognizant of time, we covered a lot of the questions that came through. I may just throw one to you, Cham. We've had a lot of questions naturally around the relevant funds that Chris and yourself have already touched on today. But maybe to summarise the webinar, could you please give indication to investors of the implications, in particular for hybrid, HBRD, for BHYB, and for B-sub?
Yeah, again, just to reiterate, we cover the full capital structure. We cover all elements of bank credit more broadly. We have a full capital structure solution in HBRD, and Chris has really touched on just how broad the investable universe is and the opportunity set in that product. We also have dedicated cash, senior bank credit in coupon, tier 2 subordinated in B-sub, as well as our BHYB product, which invests in listed bank hybrids, which still have a long runway. So in terms of what will happen going forward, in the short term, nothing. Really, again, there's a very lengthy consultation and implementation process. And these hybrids will exist for several more years. Over the longer term, we'll obviously be monitoring developments, be following closely all the communication that comes in from APRA, as well as some of the feedback that will come in as part of this consultation process, and we'll communicate with our investors in a very timely manner. But again, I just reiterate that this proposal will involve a fairly lengthy implementation and consultation process.
Perfect.
And just quickly, I did see one of the questions coming in about the potential of maybe listed, and Chris also did cover that, which is quite an interesting development if it were to happen.
Yeah, and just on that note, guys, on listed tier 2, I should make clear to the listeners, I didn't mention this point, that we've already had a big listed tier 2 market in the past. So ANZ, NAB, Westpac did huge $2 billion deals, subordinated bonds, tier 2 bonds on the ASX, particularly around, I think, 2012 and 2013. And the listed market actually was a very important destination for tier 2 investors at a point in time when institutional investors didn't want to hold tier 2, when they changed some of the terms around tier 2 with the introduction of Basel III. So, we'll see what transpires, but it wouldn't surprise me to see listed tier 2.
Perfect. Thank you, Chris. Thank you, Cham. Look, that'll conclude today's webinar. Any questions that came through that we didn't get to, your account manager will reach out to you to make sure it was covered in the webinar. Look, as Cham mentioned, we'll continue to provide timely updates to our investor base regarding APRA's proposal and any implications for our funds. But with that, I'll just once again thank Chris and thank Cham for their time.